Hey everyone, welcome back to the Income Stacker. This is Randy Rodenhouse with video 3. Today we're going to talk about passive income case studies, a few case studies of what we were talking about in the previous videos. So let's get started and take a look. So we're going to go through a couple case studies with mortgage notes or deeds of trust. We're going to give a couple case studies with private lending. And then we're going to wrap it up with a case study from a rental property. Again, this rental property was acquired through the note, and which is a little bit unique rather than going out buying a rental property and renting it, or buying a property and renting it. We're basically acquiring the property through the note process. We happen to foreclose, take the house back, and we'll talk about that in a second. So let's take a look at our first case study with a mortgage note. Now, this is actually a note that was located in Houston, or the house is located in Houston, Texas. So in actuality, it's a deed of trust that we purchased. And this deed of trust was a non-performing deed of trust, meaning the person was not paying. I think it was like almost 2 years they had not paid. The value of the house was roughly $130 at the time of purchase, and it was a 3-bedroom, 2-bath house, roughly 1,528 square feet. It's a pretty nice little single-family house there. And again, you can buy these notes. That's the beauty of notes. You're not stuck to your own backyard. You can buy notes in different states. So what did we do here? Well, the workout was really we decided to work with a homeowner, which we always want to try to do, and we did a loan modification with the homeowner, and this is what we came up with. So they had an unpaid principal balance of $99,670. The principal and interest payment that we came up with for them that they thought was acceptable to them, that they could be able to pay. Now, remember, I didn't get into all the numbers before, but they were paying a much higher principal and interest payment. So we reduced the interest rate from, I think it was like 8% down to 6.5%, and we got a term of 180 months. So they agreed to those terms. We agreed to the terms, and we're good to go. Now, did we purchase the note at $99,670? No. We purchased this note at $68,772, which if you look at the investment to value, that means the investment, which is $68,772, if you divide it by the value, which is $130, that is 53%. So are we safe? Absolutely. We'll always get our money back. And if something happens, actually, we'll probably make more money, a lot more money. So the investment to balance, meaning if we take our investment, which is again $68,772, and divide it by our unpaid principal balance of $99,670, again, we're at roughly 69%, which is good as well. So if you do all the math on it, the internal rate of return was roughly just shy of 13%, which is very good. And remember, you're making this day in and day out, right? Meaning, you don't have to worry about going back and finding another deal, right? When you're doing fix and flips, you got to buy a house, sell a house, make the money, and then you got to guess what you got to do next. You got to do it all over again. Here, I'm sitting for 15 years making a payment of $868.23 every month, 180 months in a row. Very passive, very, very easy. Finally, the total interest to us will, if they paid it off in full over that time period, would be roughly $87,500, and the total paid in was $156,281, which includes the principal price of the note itself. So looking at these things, once you get something like this and you basically are getting passive income, there's nothing better, right? You get 10 of these, you're making $8,000 a month, like clockwork, without doing a whole lot of anything. So this is the beauty of the mortgage notes. So let's take a look at another case study. This one was in Memphis. Again, this is probably should be written up as a deed of trust because, again, in Memphis, it's a deed of trust state. This note actually we bought as a re-performing, meaning it was already re-performing. It was non-performing at one time. The prior servicer lender had worked with the homeowner and got it re-performing. and the value of the house now was roughly 124. It's a 4.2, 1,700 square foot house. So they had done a loan modification with the homeowner, and they established the term shown here with an unpaid principal balance of roughly $120,000, principal interest payment of $731, which they agreed to, interest rate of 5, and term of 276 months. So did we purchase this for face value? Of course not, right? We paid $69,000, which is roughly 58% of the unpaid principal balance, and we are very safe because we're sitting at 56% loan to value or investment to value, whatever way you want to say it. So again, the return is just shy of 12%, 11.89 to be exact. Our total interest will be paid over those 23 years of $132,957. So we will get back $202,000 roughly back in total, and everything is good to go. Love these things. If I could do, if I could find notes like this all the time, it would be fantastic. You have to do a lot of searching to find these things, but once you do, you can make a lot of good money. So let's look at the private lending case study 1. So again, this is where we talked to somebody that was going out and fixing and flipping properties. They also had this property where they just wanted to rehab it and refinance it and rent it, right? So they already own the property. They just wanted some money for rehabbing, and then they're going to go out and refinance it with a bank and rent it. So we lent them money to do that. So this property is located in South Carolina, and the value of the property in the current condition before we lent the money, before they fixed it up, was roughly 64. They figured the after repaired value would be around 110. It's a 3-bedroom, 2-bath house, 1,350 square feet. So we lent them $31,500 at an interest rate of 12.5%. They gave us a payment of $328.12, a term of 12 months, and minimum term of 6 months, meaning if they got this thing done in 1 month, for example, they would still pay us 6 months of interest. We also charge 2 points. A point, for those who do not know, is a percent. So 1 point is 1%. 2 points is 2%, and so on. So it's a percentage of the loan amount. So 2 points or 2% is 2% of $31,500 or $630. And that is, we collected that up front. So if you do all the math, again, we're sitting very, very safe, right? Because our investment to value, or a lot of people call it loan to value, is 49%. Pretty sure we're going to get our money back. And if we don't, I might be even happier because I'll get a nice house that's worth $100,000 already fixed up for $31,000. So you can't beat that. Our investment to balance, of course, is 100% because, we loan $31,500. We're going to get back $31,500 plus the interest and points. So it's unlike the notes where we're buying them at a discount. We're just lending money, so there's no discount here. Now, there's ways to have other people generate these notes and you buy those notes at a discount, but that's not what we're talking about here. So internal rate of return is 14.5%. Nice return. Total interest is roughly $4,600. So again, a nice way to make money, secured, and you're going to get your money back. Here's a property in Florida where this person was wanted to buy it, fix it, and flip it. So the value, this property was $76,000, and after repaired was roughly $131,000. It's a 3-bedroom, 2-bath, 1,610 square feet. They wanted a loan of $49,400. Well, that's the loan we agreed to. We wanted some skin in the game from them, so we lent them this amount, which was roughly 65%. So again, we want to be right at 65 or below. Sometimes we go a little higher depending on the situation. So we lent them $49,400 at an interest rate of 12% straight. Their payment was $494 a month for 12 months. Again, a minimum term of 6 months and 1.5 points, or $741 up front. So again, we're pretty safe since we're sitting at 65 cents in the dollar. If they don't pay, guess what? We get the house back. The investment to balance is, of course, 100%. And finally, the internal rate of return is 13.5%. And we are going to collect almost 10 grand in interest during that 1 year period of time. So again, very safe, very secure. You want to be working with people that do know what they're doing in terms of rehabbing, right? But at the same time, you can put things into place to make sure that they're getting it done correctly by doing escrows and so on. But I'm not going to get into the super detail here, but you get the idea. Okay, here we're looking at the rental real estate, and we're acquiring the rental real estate through the note. Instead of buying the property and then renting it, we're actually acquiring the property through a foreclosure on the note, since the person was not paying. So let's take a look at the logistics here. We're buying a non-performing note, and when we do, there's a few options. One, we could do a loan modification. That was not an option since the person was not wanting to stay in the property. Number two, we could wholesale the note, meaning we buy the note for one price and sell it for another, just like wholesaling a property. Or three, foreclose, take the house back as what's called an REO, or real estate owned. And then we could do either sell the property now that we own it. We could sell the property with owner financing. We could rent it or lease option it, right? Those are some of the options. So in this case, we foreclosed on the property, took it back. Now we own the property. We took the property. Instead of selling it outright, we decided to sell it, actually rent it. Rent it. In this case, we did a lease option instead of just a straight rental. That way we got more money down to secure ourselves a little further. So that's kind of the way you can acquire real estate through notes, which a lot of people don't know. And it's just something that is possible. And usually you can get pretty good discounts when you buy the notes at a big enough discount. And that way you can make the numbers work. But again, our main goal is working with the homeowner, getting them modified, getting them reperforming. But if they don't want to live in the house, for some reason they want to get rid of it, they want to move, and then a lot of times we have to foreclose to wipe off the junior liens or wipe off any debt they have in the house for us to get clean title. Okay, so hopefully that makes sense. So here's an example of a property that we did just this. We bought this note. Again, it was non-performing. It's in Indiana. And the value of the property at the time was roughly 80 grand. It was a 3-bedroom, 2-bath house, pretty decent condition. It's 1,400, almost 1,500 square feet. And we proceeded to foreclosure, got the property back. The judgment amount in this case was roughly $78,000. There was no bidders at the auction. The loan reverted back to us as the lender, right? So we now own this property because no one else bid higher than our judgment amount. And the note purchase price was $41,000. So we actually purchased this note at $41,000. We had our cost, of course, foreclosure, right? That's pretty expensive to foreclose, mostly in some longer foreclosure states like Ohio, Indiana, South Carolina, and so on, Florida. But either way, with that cost involved, we still make money. So the investment to value here was 52% plus our cost. Foreclosure costs can range quite dramatically, and I haven't included it here. So, typically be roughly $5,000 for that. And then, we decided to rent it. So we rented it at $1,095 a month. By the time we pay our tax and insurance, we're netting $825 a month for a return of roughly 24%, which is pretty spectacular. Plus, we got $10,000 down for an option consideration, so this person could exercise their option and buy the house, because we're always trying to find and get homeowners in our houses, not just tenants, right? Tenant buyers, people that want to be homeowners at some point in the future. That's our goal. More home ownership in America. So this is a good case study of a property that, we took back, and it worked out for the homeowner too, because they didn't want it. They wanted to move on. So it was a win-win situation for everyone. Okay, now let's take a look at a few case studies with an IRA and a 401k. Let me give you a little background here. Back in 2013, I did a couple proof of concept experiments. I wanted to find out, how quickly I could build my wealth through notes, private lending, and rental real estate. In this case, it was notes. I set up a couple separate accounts, one with a self-directed IRA and one with a solo 401k. Starting with $145,000 in the self-directed IRA and $173,000 in the 401k. And then I started buying notes, right? Performing notes. And these are the results. So all the money that would be obtained through the payments would be reinvested into other notes. And since the start back in 2013, I've generated over $1.3 million in passive income during this period. And I still have a balance of almost $2.5 million, meaning $2.5 million is still owed on these notes that I've purchased. So you can see the power of the compounding and reinvesting. And there was no additional capital was added except for the allowable 401k contribution. There was nothing added to the self-directed IRA during that time. So even with starting with, $315,000, this was built to $2.5 million is pretty spectacular. And you can see the power of the compounding and the power of the notes. So hopefully that gives you a little bit of eye-opening experience in terms of what's possible outside of just, what everybody does. Stocks, bonds, and mutual funds, right? There's other things out there that can build wealth a lot faster. So Income Stacker is all about helping you build passive income through real estate mainly. And I would suggest going to incomestacker.com and signing up. There you will receive information via email if we have other videos or whatever it may be, other trainings. So best thing to do is, if you enjoy these videos, to go to incomestacker.com and sign up, and we'll see you on future videos.